Activist hedge fund JANA Partners has its sight on Qualcomm. Now, JANA's founder, Barry Rosenstein, told CNBC on Monday that it had constructive discussions with the company about potentially spinning off its chip unit. Here's what he had to say.
We have advocated a number of steps, not just a split up. And in fact, what we think they ought to do is just a transparent review of the combined businesses and determine whether or not it makes sense to do either a partial or a full split.
All right, so joining us now to discuss Qualcomm is Brian Colello. He's the senior analyst at Morningstar. And Brian, what are your initial thoughts on that soundbite that we just heard from Barry Rosenstein? He says he's not suggesting an immediate split, but a transparent review of the company. What exactly, from an analyst standpoint, is a transparent review of the company, and what could it mean for Qualcomm?
Sure. Well, I think it's important to consider even the history about this, that Qualcomm was thinking of splitting up these two businesses about 15 years ago before deciding to keep them together. And from time to time, when there have been investigations into the licensing business, it sometimes extends to chips. You know, these businesses are run or supposed to be run as two different silos on the licensing and chips, but certainly there's been indications that maybe there's, I guess, either cross-selling or some sort of maybe they're not being run as those silos exactly. So I think that kind of indicates the transparency part that Qualcomm needs to kind of clearly communicate and look into the fact that licensing runs as is, chips run as is, and whether both businesses would be better together or apart. We still think they're better together than apart. Certainly the licensing business is highly profitable, brings in a lot of cash that they can use to fund that R&D, that it's funded a lot of that chip growth over the past few years, and we think there is more chip growth to be had, even with some recent market share losses and concerns. There's certainly upside for the chip business, and so we think it makes sense to harness some of that licensing revenue and that strong cash flow to continue to spend in R&D and move the needle on chips. I think it still makes sense as a business as a whole.
All right, so Brian, you think that the company stays or is better off if they keep those businesses combined. But here's the point here. Shares of Qualcomm have fallen already about 6% since the beginning of this year. So what do you think Qualcomm needs to do to unlock some of that value if, by your suggestion, they do keep both those businesses together?
Sure. I think the real question is whether it makes sense, if you're going to spin off the chip business, does it make sense to just harvest the licensing cash flows, pay that out to shareholders, and be a very high-paying, dividend-paying cash distribution business, and so you harvest the licensing and you let the chips fend for themselves in a brutally competitive market, or whether you have enough synergy, whether there's enough growth in that chip business to kind of turn around what they've been doing and to grow again. Certainly we saw tremendous growth from a lot of favorable things, getting into the iPhone, the growth of LTE where they have the dominant position. Now we're seeing the competition catch up, and we've always thought that Qualcomm would lose some market share over time, whether it's to Intel, whether it's to Samsung. Certainly they're losing both right now, and there's potential to even lose more. But at this point, we kind of agree with JANA Partners that that chip business is being valued at close to zero today, and certainly it's a higher quality business than that. Certainly there's opportunities in chips, not just in smartphones, automotive, Internet of Things. There are a lot of places Qualcomm can go to get growth, and to kind of pull it off of that cash flow from the licensing business, again, doesn't really make a lot of sense to us.
Brian, I want to hit on this because they have a lot of products, right? But what Qualcomm got so much notoriety for was that wireless business, right? The wireless chip business, the mobile chip. I mean, how is it comparing? You mentioned some of its rivals here. How exactly is Qualcomm doing versus its rivals in this mobile chip space? Because it's cutthroat, right? I mean, there are a lot of players. It's all about costs, and it's a very commoditized business.
Sure. Well, Qualcomm has seen tremendous growth in its chip business, and it was thanks to its LTE expertise. They were the first company out with a high-quality LTE baseband chip. They were the first company to have a high-quality integrated processor, so you're kind of taking the two most important parts of the phone, the processor and the baseband, and combining them into one chip. They had a technological advantage for quite some time. The competition has caught up, and so Intel has a very high-quality baseband chip. Samsung is going with its own processors in its new phones. So this stock tends to trade based on chip market share. Again, because it's volatile, certainly Qualcomm looks like it's in a down point now. They lost share at Samsung. There's concern. There was a rumor that they might even lose a little bit of share at Apple. But certainly because of the competitive nature, because Qualcomm has the R&D scale to invest in the best products, we think there's a chance it can capture some of that back, and that will turn the tide.
All right, so it sounds like you think this is an undervalued company, and that's the bottom line for you, right?
We do. We're at a $75 fair value, and the company has almost $20 of cash on hand, so it's trading, close to 10 times earnings ex cash. And even if you look at just the licensing business, if you ignore the chips, look at cash and licensing, it's maybe trading at 20 times EPS from the licensing business alone. That's a high quality business that's going to grow because the smartphone market is still growing at a nice pace over the next few years as there's still plenty of room for smartphones to grow by replacing basic handsets. So we think that licensing business is going to grow very well. It's extremely profitable. So chips we look at, quite frankly, as optionality at that point. And it seems crazy to talk about that as the world's largest wireless chip maker, but we don't think it's valued for very much today. And so any upside, and whether it's getting back in with Samsung, retaining 100% of Apple, or new areas, we think there's upside on the chip business. And so from a valuation perspective, we understand why it's been beaten up because of chips, but because that licensing business is so solid, that's why we like it. We see the opportunity to buy here.
All right, so there's an opportunity, you say, to buy Qualcomm because of this underperformance so far. Brian Colello, thank you so much for joining us here. That's Brian Colello, Senior Analyst over at Morningstar. And thanks for watching The Tech Bet. I'm Dominic Chu. Have a great day.
Hey YouTube fans, I'm Landon Dowdy from CNBC. Thank you so much for checking out our channel. You can subscribe by clicking right here to check out the latest Mad Money CEO interviews, market news, financial advice, and product unboxing. Enjoy!